Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, at the time of this recording, the government has shut down. Now, by the time you get this video, maybe it reopened, maybe it did not, but I'm going to talk today about how the government shutdowns affect stocks. And by the way, if you find value in this video, if you see this video on the social media channels, go ahead and share it, or if you get it in an email, go ahead and forward it to a friend. So let's jump in and explore how government shutdowns affect stocks. And you might have seen in the news, sorry, we're closed. The government has partly shut down. And in my opinion, the Democrats and Republicans are just children crying in the sandbox. So let's talk a little bit about government shutdown history. The U.S. government has officially shut down for the first time, as mentioned, since December 2018, and this marks the 22nd government shutdown in history. Now, here are the departments that are affected. National parks and monuments are partially closed. Federal courts, of course, are open. And you could see medical research centers are partially closed. FHA mortgage programs are open. Mail services are, of course, open. So the government is partially shut down. Don't be too startled, because this is something that's happened, as mentioned, many times in history. But is this bad news for stocks? And history shows that it is not. Now let's look at some history. Modest declines often happen during shutdowns. On average, the S&P 500 has slipped slightly during shutdown periods. So 95 to 96, the shutdown was short term. The market was flat, again, as defined by the S&P 500. Now, by flat, what I mean is essentially it went nowhere during the period in which it was shut down. In 2013, the market actually gained 3%. And in 2018, 2019, which was 35 days, the S&P rose about 10%. Now, the bigger picture is shutdowns rarely affect long-term economic fundamentals. GDP growth can take a small hit if shutdown drags on, but essentially when we're in a uptrend, that uptrend tends to continue because markets tend to focus more on Fed policy, earnings, and the broader economy than the shutdown drama. But of course there is risk, and if a shutdown coincides with debt ceiling fights like in 2011, volatility can be much higher because default fears are more serious than temperate accounts. Now, again, this is probably more of a headline situation than anything, at least based on history. So I wouldn't be too worried if I were you with respect to how government shutdowns affects your portfolio, how it affects stock markets, because again, history shows that it is essentially a nothing burger, particularly when we have a sustained uptrend, which is a situation we are in now, and particularly when we're heading into the fourth quarter, which we're heading into now. So obviously the fourth quarter is October, November, and December, and you could see the very good news if you look at history. On average, the S&P 500 is up around 2.9%, historically speaking, in the fourth quarter, and it's up 74% of the time, the best quarter by far when, again, looking at market history. And as I mentioned, the trend is your friend until the end when it bends. The trend is your friend until the end when it bends. And don't lose sight of the big picture trend. I mentioned in a video last week, the market is traditionally driven by themes. The market trend is likely going to continue, dominated by three major themes. Number one, the AI, artificial intelligence themes. Usually the market has a tendency to be driven by a theme. Number two is we just had a rate reduction. There is likelihood that the Fed will reduce rates at least once more before year end. And the third thing is corporate earnings. Corporate earnings have been healthy, and obviously stock prices, or at least future stock prices, is generally speaking primarily dependent on corporate earnings and profitability. But I don't want you to lose focus. Again, that was a lot of positive news, but you must have clarity on your goals, a plan, and an investment strategy. Understand your risk tolerance, develop a growth and protection strategy, and understand what your family index number, which is the rate of return you need to earn now and in the future to live the ideal retirement. life that you want. And as I mentioned, if you find value in this video, go ahead and share it or forward it to a friend. And if you would like a second opinion on your portfolio or financial situation, this is our website at nicholswealth.com. Click on this request an appointment tab, fill out the information, and one of our advisors will reach out to you and answer your questions and give you some clarity in today's often challenging financial environment. Thanks again for watching. Bye-bye.